Welcome into today's video. Here I'm going to go through the past 1000 ideas I've read and what I've learned from them. So just for those of you who don't know, I'm talking about Value Investors Club write-ups. This is a community where professional and amateur investors sort of write up their investment thesis twice a year on average to sort of discuss and pitch the idea that they are presenting. There is a small prize as well, but a lot of it is a really good sort of hunting ground to find ideas. So I've spent the past few months looking through and vetting through these investment write-ups from qualified investors. Only about 1 in 12 people get approved. And here's what I've learned 1,000 write-ups later. So for me, one of the first things I instantly found out after sort of a few months of doing this is that I'd say about 3% of ideas are truly no-brainers, are truly great. So out of a packet of 100, you might have 3 ideas that are truly great, and even then, some of them may just be outside your circle of competence. So I think really the margin for sort of truly great is very thin. And for me, what that means is that it must be very obvious, hits me like a brick. It must have a very significant upside, because you could be right in everything that you say, that management is great, that the balance sheet is strong, performance is expected to be consistent, but at the end of the day, if there's only room for upside because of pricing and where the company sits in terms of valuation of 50% over the next few years, that isn't really all that attractive. So one of the first few things that I look for is sort of what is that margin discrepancy there between where the company currently is at and where the company could be at in the next few years, should these factors play out. And just to give you sort of a sense, some of the best ideas I've seen have had sort of potential room to grow 4, 5, 6, 10 times even over the next few years due to discrepancy. And it's not always the same clear-cut way either. Sometimes it's from a hidden asset play I've seen occur where it's not been yet recognized by the market. And other times I've seen it where it's a quality business that's potentially just had some turning points which have just been met, where the trajectory of the business is expected to become insanely profitable or start to screen really well in the stock screen, and perhaps it's just turned profitability. And because of X, Y, and Z, that's going to continue increasing at a high rate because perhaps the business might have high operating leverage. That is another really good sign there. And that's sort of something what I look for there. And what's sort of the logical reasoning behind why that expansion in price and market cap is going to occur. It must be something logical and also probable to occur. And following on from that, I think another one that I've really noticed amongst sort of these higher quality write-ups is that the business depth that the individual has. And what I mean by that is that they know the track record of management. And what I mean is not just the founder, they know exactly sort of the founder's upbringings, what drives him, his previous ventures, other sort of people in the management team. Are they part of the same sort of team that worked together 20 years ago at a separate company where they had another successful exit? So almost in a sense, they're like overqualified management where they've already had and proven massive success in this area. They've got a strong track record behind them of exceeding and excelling everywhere they've been. But equally, it could just be that certain investors in this space are becoming really interested in this company, and it's for very similar reasons. And these investors might be known as experts in the region or in their specific sort of domain. And then you'd want to know the reasoning behind that. So I've covered off the fact that you need a large margin of sort of return. The second thing is sort of great and excelling management. And I think another thing on top of that is sort of having a deep understanding of the history of the business and how it has come about. So one of these write-ups I was reading on was about the credit business, how buy now, pay later came about, and sort of the early evolution of that. And I think by understanding that, not all of it will be relevant, but it really paints a really good picture of where we were, where we are currently, and then where we are going in the future in this space. And I think that's something that's you really need to sort of understand, that helps you understand the rest of the thesis. Other things I look for as well is sort of what's the downside, what sort of asset and prevention could we sort of protect ourselves with, And this might just be, for example, if you have an unprofitable company, this might just be that you've seen other businesses which are sort of trading at, which are also losing money, perhaps they have a slight burn rate, have also just been bought out at much higher valuations. That could be your margin of safety. It could just be that the asset that the business holds in a fire sale will be worth a heck of a lot more than it currently is. It could be the characteristics of the business, but generally this is what I've noticed, is that you generally have 3% really amazing ideas that come out at you. There are obviously other good ideas in there, but I think generally the ones that will sort of outperform in the long term are these types of ideas. So when I'm looking for ideas now, if I don't see at least a potential for a 3x, to me it isn't worth qualifying, because it could be a good idea, nothing against it, but the likelihood it's going to continue and go into that sort of great bucket that where I'm truly looking for is unlikely. That's something I look for there. I think the thing I noticed as well is with a lot of these opportunities, when they truly are great, they often get filled really quickly. And what I mean by that is that the market starts to recognize their value really quickly. And a lot of the time that's just as soon as the sort of the catalyst or the event starts to play out, that can really shift quickly. So two companies I have in mind, there was one which was a buy now pay later company, and as soon as they started shifting the corner to profitability, as their operating leverage grew and as they started rationalizing and as the market became less competitive, these sort of like Lollapalooza effects of multiple positive reinforcements occurring at the same time. And as soon as that translated into the financial numbers, the company just, market cap just took off completely. Another company I had in mind was one where they had a hidden infrastructure play, where they had this huge asset that was basically being underutilized for their business. Potentially their business only needs to use up 10% of the asset. They could sell the remaining 90% chunk. And there's just the sheer depth there, where the author had gone into the depth around the sort of the committees and the boards that the management were involved in outside of this role, which sort of really played into this same space, and how that committee was tied to granting permission of the sale of the asset, how there had been public talk about selling and encouraging sales of these types of assets because it would benefit the industry. And how sort of other comparable players had also sold, and how you could calculate the valuation off the back of that. And to me, this is what I really look for when I'm screening for these ideas now. So that's really what I've learned from 1,000 ideas. I think for me, it's helped me become more picky and be able to filter through what's mediocre, good, and great. And ultimately, that's what I'm looking for at the end of the day. I'm looking for great opportunities. Hope you found this useful. Let me know how you find Value Investors Club as well. Thanks.